Hello everyone. My name is Eva from Milox News, and today, I would like to delve into a short-term investment tactic known as swing trading. Unlike day trading, where you acquire and liquidate an asset on the same day, swing trading can span from a couple of days to several weeks. Swing traders seek to capitalize on price variations to obtain compounded returns and enhance the profitability of their portfolio. Swing traders typically employ technical analysis to identify the right time to enter and exit a trade, analyzing price charts instead of conducting fundamental analysis, which involves the study of financial statements and is used in other investment strategies. When observing a price chart, you'll notice that the price doesn't usually rise or fall directly. Instead, it tends to move in a pattern of peaks and valleys. Swing traders seek to acquire at a valley, ride the rise, and sell at the peak. Alternatively, they may sell or go short at the peak, ride the fall, and then close at the valley. Despite focusing on short-term movements, swing traders usually trade with the overall trend, which means taking advantage of rises during bullish trends and falls during bearish trends. During a sideways trend, they may attempt to trade both upward and downward movements. There are three key components of a swing trade that need to be determined before making a trade: when to enter, when to exit, and how much to trade. Let's start with entries and exits. There are countless ways for swing traders to choose entries and exits. Many traders use basic charting techniques, such as support and resistance, or price patterns, like flags and triangles. Others use chart indicators like moving averages and oscillators, which can help provide more objective signals. Many swing traders start with support and resistance levels. Let's use those for an example. It can be helpful to think of support and resistance as floors and ceilings where a security's price tends to change direction within the larger trend. There are two common entry signals when trading at support and resistance: a bounce and a breakout. A bounce occurs when the price approaches a support or resistance level and then moves away in the opposite direction. Someone looking to trade off of it would set an exit target at the previous level of support or resistance. For example, when Honeywell fell near $170, which was its previous low, it bounced back up, creating a bounce. A swing trader could use that bounce to enter a bullish trade and set a price target at the previous high of around $200. If the trade worked in their favor, they could capture up to $30 per share, not considering any commission or fee. Another signal is a breakout, which occurs when the price moves beyond a line of support or resistance. A trader would set a target by measuring the previous distance between the support and resistance lines, then adding that range to the resistance for bullish trades or subtracting it from the support for bearish ones. For example, Schlumberger was trading between $38 and $44 when the stock broke above the resistance, a breakout that signals a possible entry. The range between the support and resistance was approximately $6, which, if added to the resistance, would show a target at $50. Regardless of how a trader determines entries and exits, it's crucial to have a plan in case the unexpected occurs. In fact, it's common to have two planned exits, one for if things go well and another if things go wrong. Many swing traders use a proverbial line in the sand known as a stop, which helps them determine when to abandon a trade that's going in the wrong direction. For example, a trader might decide to close this example trade if the stock falls to $43. Some traders use a real stop order, while others closely monitor the price or set an alert and then place the order themselves. It's important to know that stop orders often do not execute at the stop order's trigger price. When a stop order is activated, it creates a market order. When the stock trades subsequently, it could be very different from the desired price. Before making a trade, traders need to determine how many shares to buy. Some factors can help calculate how much to invest in a trade, including the stop price and portfolio risk. Let's say we have $50,000 in a trading portfolio and we're willing to risk no more than 1% of the portfolio on a trade, or $500. This is the portfolio risk. Next, we'll divide the portfolio risk by the trade risk, which is the difference between the entry price and the stop price. For our example, let's say the trade risk was $2. If we divide the portfolio risk of $500 by the trade risk of $2, we could buy 250 shares. Of course, this is just one way swing traders calculate their position size. You'll want to find a method that's more suitable for you and adjust it to fit your risk tolerance. Comparing the trade risk with the potential reward can also help determine whether a trade is worth it. Let's say a trader bought a stock at $55 per share with a price target of $60. They decide to close the trade at a loss if the stock falls $2. That means they're risking $2 to potentially earn $5, not considering any fee or slippage. But if the target was $56, with the potential to earn $1 while risking $2, it could mean that the reward may not be worth the risk. There are other risks in swing trading, such as the stock exceeding its target or not reaching it. In our first example, the stock continued to rise beyond its price target and, if the trader sold, they would have missed out on those additional gains. That's a risk a swing trader must be willing to accept. Then, in our second example, the stock came very close to the target but didn't quite reach it before starting to fall. If the trader was waiting to close at the target, they would have missed out on the gain. One way traders try to mitigate this risk is by adjusting their stop orders as the stock rises to try to lock in gains. Just remember that relying entirely on stop orders could result in missing out on some potential gains and carries the risk that orders may not execute as expected. There are many ways to approach swing trading, so start by determining which techniques and indicators best fit your trading style. Then explore money management strategies that work for your risk tolerance. Finally, practice paper trading with your strategy before putting your hard-earned dollars at risk. If you found this information helpful, please don't forget to hit that like button. It really helps us out and lets us know you're enjoying the content. And if you want to stay up to date with the latest from us, make sure to subscribe to the Milox News channel. We have plenty more insightful content coming your way. Thanks for watching, and we'll see you in the next one.